Hello, we are DST Investments, a consulting service provided by Fiduciary Capital Management, a registered investment advisor, also known as an RIA. Fiduciary Capital Management provides real estate investment advisory consulting services on Section 1031 and Section 1033 tax-deferred exchanges, and Delaware Statutory trusts, which are most commonly known as DSTs. Today, we're going to discuss the 1031 exchange, commonly known as like-kind exchange or 1031s, and how they can be smart tax strategies for business owners who also own and invest in real estate. Having a professional advisor assist you throughout the process and understanding just 12 fundamental elements of DST 1031 exchanges will make you more informed to know if a 1031 strategy will fit into your overall tax and real estate plans. We can assist in balancing all aspects of the exchange and acquisitions. We conduct due diligence on DST sponsors, provide portfolio modeling, and other consulting services on Section 1031, Section 1033, and opportunity zones. Our objective is to achieve portfolio diversification by geographic location and asset classification. In today's market, your businesses may have held real estate for some time. Chances are you will most likely have a capital gains in addition to depreciation recapture, which is subject to a 25% tax rate upon sale. This could be possibly higher depending on your state or residency. It often adds up to a large tax liability and subsequently less proceeds of the sale to reinvest in the purchase of a new real estate asset. With the 1031 exchange, the IRS allows you to defer the tax liability on the sale of real estate assets used in a business that are held for investment until the replacement property is ultimately sold. Let's illustrate with an example. In this scenario, a $5 million building has been depreciated by $3 million over time, making the tax basis $2 million at the time of sale. If the building is sold for $8 million, there is a $6 million gain, which includes a $3 million depreciation recapture at a 25% tax rate. Without a 1031 exchange, this $6 million gain would be taxed as follows. First, the $3 million gain is taxed as unrecaptured at IRS Section 1250 rates of 25%, which equals $750,000. The remaining $3 million of gain is taxed at capital gains rate of 20%, which is $600,000. For federal purposes, if you are a passive investor, net income tax could be 3.8%, which is another $228,000. If we take an average state tax of 5%, that would be an additional $300,000. So the total tax bill is $1,878,000. Rather than having the $8 million of cash, you are left with only $6.1 million of cash after taxes are paid. But successfully executing a 1031 exchange could take the entire $8 million to reinvest in a new property. You may be asking, how long can one defer this tax liability? The second fundamental element deals with succession planning. If you've completed a 1031 exchange throughout your lifetime, the taxes will be due upon the ultimate disposal of the property. But if you can hold the replacement property or do subsequent 1031 exchanges on future sales, when your successor ultimately inherits the property, they will receive a step up in basis equal to the fair market value of the property at the time of death, and a deferred gain is never recognized. Another succession planning strategy is using a 1031 exchange to transition into different real estate asset classes. Investors preparing for retirement or planning to leave real estate to their heirs who do not want active management responsibilities can exchange into properties with long-term leases that require very little day-to-day oversight. Today's market offers a variety of income-producing properties designed to provide consistent cash flow through a more passive ownership approach. We frequently help clients manage and reposition their real estate portfolios to better align with these passive investment objectives. By deferring capital gains taxes through a 1031 exchange, investors preserve more equity to reinvest into larger or multiple properties, potentially enhancing income, increasing long-term returns, and improving overall portfolio diversification. Now that you understand some of the advantages of a 1031 exchange, the next question is, how the process actually works? A successful exchange requires strict compliance with IRS rules and deadlines, making it important to work with experienced professionals who coordinate these transactions regularly. Here are a few key elements. Both the relinquished property and the replacement property must be held for productive use in a trade or business or for investment purposes. Property held primarily for resale, such as fix and flip projects or inventory, do not qualify. Under the Tax Cuts and Jobs Act, only real property is eligible for Section 1031 tax-deferred exchanges. Personal property, equipment, artwork, collectibles, vehicles, aircrafts, and most intangible assets are no longer eligible. Because state laws and regulations may vary, investors should confirm how real property is defined within their specific jurisdiction. The taxpayer who sells the relinquished property generally must be the same taxpayer who acquires the replacement property to satisfy Section 1031 requirements. In addition, investors typically must reinvest all net exchange proceeds and replace any debt paid off on the relinquished property, or contribute additional cash to fully defer capital gains and avoid taxable boot. Because every exchange is unique, we encourage you to contact us for a personal consultation to discuss your specific circumstances and planning objectives. Remember, the same taxpayer who sells the property needs to be the same taxpayer who acquires the replacement property. The 1031 exchange timing is critical. You have 45 days from the close of the sale of the relinquished property to identify replacement properties. There are three methods of identification that an investor can employ. The first is the three-property rule. An investor can select up to 3 properties. The investor can purchase more than one of the properties on the identification list to complete the exchange, as long as it's for an amount equal or greater to the relinquished property. This is the most common method of identifying replacement properties. The second is the 200% rule. You can identify an unlimited amount of replacement property as long as it doesn't exceed 200% of the relinquished property sold. And third, there is a seldom used 95% rule that allows investors to identify as many properties as you wish with a value that can exceed 200% as long as you close on 95% of those properties. Another consideration is that after closing on the relinquished property, the 180-day rule starts counting down. You have 180 days from the sale of the relinquished properties to close on the replacement property. With today's market conditions, we strongly advise to have replacement properties identified in advance of the front-end sale, meaning the relinquished property, to be able to conform to these time requirements. This is a graphic illustration of the time periods you must be aware of. There are no extensions to the 45-day identification period. The qualified intermediary must have your replacement list by the 45th day, and no extensions to the 180-day rule, even if the 180th day is a weekend or holiday. In that case, the closing would need to happen before 180 days. The fatal flaw on a 1031 is that you cannot touch the cash. By law, you cannot touch the money. A basic fundamental element of a 1031 exchange is you must use a qualified intermediary or QI, which can cost a few $1,000s. Essentially, they handle the transfer of funds so the cash never touches your hands. Title companies, attorneys, or escrow agents cannot hold the funds for you. It must be a QI. There are several compelling reasons why investors completing a 1031 exchange choose a Delaware Statutory Trust, or DST, as a replacement property. With a DST, investors own a fractional interest in institutional quality real estate without the responsibilities of day-to-day property management. Leasing, maintenance, tenant relationship, and asset operations are handled by professional property managers under the oversight of a DST sponsor. This structure is especially appealing to investors who want to preserve the tax advantages of a 1031 exchange while transitioning to a more passive, professionally managed real estate investment. Another important reason investors choose a Delaware Statutory Trust as a 1031 replacement property is diversification. Diversification extends beyond simply investing in different property types. It can also include geographic markets, tenant profiles, and multiple DST sponsors. With minimum investments often starting around $100,000, DSTs provide investors with the flexibility to spread their equity across several institutional quality properties located throughout the United States. This approach can help reduce concentration risk while preserving the tax benefits of 1031 deferred exchange. Another reason investors choose a Delaware Statutory Trust as a 1031 replacement property is the availability of non-recourse financing. Many investors selling investment real estate prefer not to assume new, personally guaranteed mortgage debt. With a DST, any financing is generally non-recourse to the investor, meaning there are no personal guarantees or direct liability beyond the investment itself. It's also worth noting that some DST offerings are structured with little or no leverage, helping to reduce the overall investment risk while providing greater flexibility for estate, tax, and long-term financial planning. Delaware Statutory Trust offerings are structured and offered as securities under the Securities Act of 1933. As a result, prospective investors receive a private placement memorandum, or PPM, which provides detailed information about the offering, including its investment objectives, risks, fees, expenses, financing, and other important disclosures. The PPM also explains the investor suitability requirements. In most cases, investors must be qualified as accredited. Generally speaking, they have a net worth exceeding $1 million, excluding their primary residence, or have an earned annual income of at least $200,000 individually, or $300,000 jointly with a spouse or qualifying partner for the past 2 years, with a reasonable expectation of continuing that income. Certain trusts, business entities, institutional investors may also qualify under the accredited investor rules. The final consideration is choosing the right professional to guide your transaction. Do you want an advisor who acts in a fiduciary capacity, placing your interests first, or someone whose role is limited to a commission-based transaction? At Fiduciary Capital Management, we provide independent consulting and advisory services involving private real estate investments, including 1031 exchanges, 1033 exchanges, Delaware Statutory Trust, opportunity zones, and other tax deferral strategies. Our decades of commercial real estate and investment experience are dedicated to helping clients make informed, objective decisions. If you have questions about a 1031 exchange, commercial real estate, or DST investments, we invite you to contact us. call us or email us at adinicola@fiduciarycm.com. This presentation is intended to provide a general overview of 1031 exchanges and Delaware statutory trust and is not a comprehensive discussion of every tax, legal, or investment scenario. Likewise, it does not describe the complete details of any specific DST offerings. Those important details, including investment objectives, risks, fees, expenses, and suitability requirements, are contained in the applicable private placement memorandum or PPM. If you're considering a 1031 exchange, evaluating current DST opportunities, or are already within your identification periods, we encourage you to contact us as soon as possible to discuss your circumstances and financial goals. Thank you for taking the time to watch this presentation. We look forward to assisting you.